Kaylin, I'm ready to go. So, good morning, everyone. My name's Craig, Ian Craig, also known as BDO's Eye on Tax. And that's my little tribute to the great Sean Connery, who passed away this week. I'm delighted to be joined today with my good friend from Christchurch and BDO's National Service Line Leader for Tax, Mark Lauder.
Morning all. I'm not as James Bond as Ian, but a very good morning to everyone. And that's it from me at the moment. Back to you, Ian.
Okay. Yeah, good morning. So everyone, what we're going to do today is run through the post-election tax landscape. The Labour government obviously were in power, and they introduced a whole lot of tax changes that before the election. So they only had really one tax policy in their manifesto, and that was the increase to the personal tax rate to 39%. So we're going to focus a little bit on that area. I posted a video out immediately after the election, which suggested that it would be a good thing for taxpayers to look at three potential action points. Reviewing your existing ownership structures to determine if they're still fit for purpose. Look at whether it's worthwhile paying some dividends immediately. And looking at whether this tax rate change is enough to warrant changing the way in which you remunerate your very senior people. We will then, we're going to run through those three topics, and then we'll have a session for questions and answers. Our hope and desire for today is to generate some ideas. There is a truism in tax that everybody's tax position comes out of their own personal facts and circumstances. So really what we're trying to do today is to create some ideas that you will allow you to talk to your advisor, work out some numbers and work out some strategies that might work for you, but you should talk to your advisor in implementing those. If I have the next slide, please. So as I said before, Labour had introduced a lot of tax changes as part of their COVID relief response. We have presented on those before. Mark and I presented back in around April time. And there's a very good BDO COVID website that you can refer to, but I think most of you will be familiar with them. There is one tax change that was announced as part of COVID which hasn't come out yet, and that is the ability to carry forward tax losses where you satisfy a business continuity test, i.e. your business hasn't changed enough, you've had a change in shareholder, which would normally result in the losses being forfeited. We are aware that the Inland Revenue have been working on the framework for that change, and it is expected to be released imminently. I think the release is effectively being deferred by the election. So the one that we're going to focus on today is really the post-election tax change, which was the increase in the personal tax rate, the 39%. Now, it is the manifesto of Labour in the pre-election was very silent on detail. It literally said there will be no new taxes. There will be one increase in the personal tax rate, and that will apply to individuals with who earn income in excess of $180,000, and they will pay tax at 39%. What it didn't have is when they will implement that and how they will implement it. So from a when perspective, my own personal pick is that it will be coming on 1 April 2021, so it'll apply for the full tax year next year. Now, the reason I say that is that we've had mid-year tax changes before where the rates have changed or the bands have changed, but they have generally kicked in at 1 October. And where there's a 6 months of the tax year still to apply. I personally think that if they were to bring in the 39% tax rate early, the only practical date they'd bring it in from would would be 1 January. And I don't see that happening. But what our tip today will be is that you should prepare and take some action before Christmas, just in case they spring a surprise on us. How they can do this? Well, there's some legislation that needs to be implemented to impose the new rate. There is a tax bill that's currently before Parliament, so it could be added to that tax bill, or they could introduce a new piece of legislation. But I think the common sense position would be that it should come in at 1 April 2021, but be prepared like all good Boy Scouts. Caitlin, for the next slide. Yeah, so what I wanted to do is just to emphasise the dollars and cents here. The Labour government made the announcement that really this was only targeting the very top earners and that it would only apply to about 2% of the population. So the actual tax increase, assuming that it's 1 April 2021, for someone who's on 250,000 is around $4,200. It'll be a cost of about $350 a week. At 350,000, it's around just over $10,000. And if you're on 500,000, then it's 19,200. So what we're talking about are really those really top earners in your business, or the owners of the businesses who are having a successful year and might end up paying tax at that higher level. Of course, it is, you could look at it and say, look, if I'm earning 250,000 and the tax increase is only 4,200, is it really worth doing some tax planning to cover that? And there'll be a marginal call around what cost versus benefit of taking any action. But remember, these are annual increases, and so it applies every year. And depending on how long you think the 39% tax rate would remain in the tax system, it would be, the cost would accumulate over time. Now, we have been here before. We've had 39% tax rate before. I think it was introduced in 1999, and I remember questioning Helen Clark and opened a question at a British New Zealand Trade Council seminar where I said, Helen, as a tax partner, I thank you for the business development opportunity that you've presented us by increasing the 39% tax rate. And of course, it was introduced back then at income over 60,000. And by a very rough calculation, that meant that the extra tax costs back then was a further sort of $7,200, if you like. The difference between 60 and 180,000 at 6%. So you can see that the tax cost increased significantly to close to 30,000 if you're on 500,000 and close to 20,000 if you're on 350,000. Next slide, please. So one of the things that we have, because we've been here before, I think we need to take heed of the lessons that have been learned from the last time. And this is a graph that kind of reflects the well-acknowledged fact that as tax rates go higher, there is an increased incentive for taxpayers to try and save tax by, or reducing their tax bill by what people thought was legitimate tax planning, but that the Inland Revenue took a view was more of an avoidance nature, and I've described in the bottom line as being of bad behaviour. Now, a few years ago, David Partington, who's a very senior official at tax policy, spoke to a BDO tax conference and talked about how our tax system has been hugely successful based on a broad-based low-rate tax system. The tax policy hated when they had the differential tax rates. They said it created a distortion in the tax system that created a whole lot of behaviour that they then had to counter. You know, the difference between personal tax rate at 39%, the trustee tax rate at 33%, and the company rate that applied at the time. And because it created behaviour, they then had to counter it, which led to years of changes in legislation and case law. So they always thought that they would align future rates, and if it was to be an increase, it would go to 36%, 36%, 36%, rather than 33, 33, 33. But that was then and this is now, and this is what we've got. Now, it doesn't mean to say that the bad behaviour would carry on with this in particular increase. I think that the motivation, the arrow would be a shallower arrow. The steepness of the arrow would be shallower because it's only kicking in for income over 180,000 and reflects that cost benefit that I spoke to before. So we're going to run through some of the ideas and some of the lessons we've learned from the last time, and I'll pass over to Mark now to run through a review, the first of those action points.
Thanks, Ian. I've just realised I'm looking very white, and it could be construed that I'm in a white padded cell. So first off, I do like colour, and I can assure you that I'm not in a white padded cell, so we're all good here. Now, Ian's made a reference to 1999, which leads me to think I'm going to start off with a couple of two or three fun facts, of which one of them is incorrect. So if I start with my first one, and Ian, you'll like this, back in 1999, I celebrated at the Edinburgh Hogmanay, and while I was there, the crowd moved so much that I got removed from all of my friends, and I had to celebrate the new year or the new millennium with a group of people I didn't know. So that's the first one. The second one is, and there's a rumour going around that the $180,000 threshold proposed or going to be introduced is as a result of after policymakers were watching the World Darts Championships, landed on the number 180 and decided on $180,000 as being the threshold from which the 39% rate comes in. My immediate reaction is, thank goodness they didn't go for 180% being the top rate. And my third is, while Ian mentioned that the 2%, or sorry, that the impact is only going to affect 2% of the population, there is a metric out there that states 3% of the top earners make up 25% of the total income tax take for the country. So those are my three things. I'll give you a minute to work out which one's incorrect. Actually, I won't give you a minute. If any of you thought it was around the Hogmanay, you'd be correct. I was at the Hogmanay, but I didn't get split up from my friends. So well done to all of you who thought that. Excellent. And for a prize, please contact Ian. Thanks, Ian, for volunteering to offer something up. So now we're going to run to structures. I think it's pretty clear. We've got, look, just here the slide refers to our choices. We have our sole trader moving to a 39% tax rate. Companies and trusts, 28 and 33% respectively. Trusts having a greater flexibility to income split through beneficiary income means. And your limited partnership LTC look-through company structures, which is represented in theory by a glass of water that is transparent. So those structures offer transparency for tax purposes. At the moment, the information we are receiving and have heard is that the company and trust tax rates will remain static, no movements in this regard, and therefore that lends itself to structural planning opportunities, which we will now consider in the next couple of slides. If you shift through, please, Caitlin. Okay, so we have the first slide, and look, before we start, look, the numbers are there just to emphasize a point, but what we've done is we've started from the point that the individual is already on $180,000 and that anything coming out of the company as a dividend is on top of that amount, just for ease and just to emphasize the point. But you still need to bear in mind Ian's points regarding is it really worth it? So the first structure, you've got your normal company owned 100% by individuals. Company makes money, pays tax at 28 cents in the dollar, and then the individuals want their cash. It pays a dividend. At the point in time a dividend is paid, you're going to walk into that 39% tax rate. The question arises, well, why are we holding the shares as individuals? Should we be using and adopting a trust as the trustee shareholder for the company of which the individuals are entitled to benefit? As you can see from the example, there's a fairly decent tax saving to be made there based on the assumption I already made that we're already at the 180,000. Caitlin, next slide, please. Next slide here, the really simple one. We're operating as a sole trader. Why don't we just transfer to a trust? Again, there's an absolute advantage here. We would be taxed at 39% if we were acting and operating in our own right as individuals. However, if we trade as a trust, we have the benefit of the top trustee rate of 33 cents in the dollar, and perhaps the ability to income split through beneficiary income means. And the last slide offers a deferral advantage. It's a bit of a rehash of the very first one. It's starting from inception rather than from the individual owning shares in a company. Again, we have an individual just operating as a sole trader. Advice is that perhaps it would be a good idea to get some commercial risk protection. Use a company, for example. The company pays tax at 28 cents in the dollar as opposed to 39 cents for the individual. This only offers a deferral advantage because, as we've just talked, when a company pays a dividend out, we start potentially walking into that 39% tax rate. So it's a deferral advantage only. Now, before we change structure, we do need to think before we act. For example, if we are moving from a sole trader and transferring our business and its assets to another entity, will that crystallize or trigger any tax consequences by virtue of having types of assets within the company that would trigger taxable income upon sale? So by this, I'm referring to, in particular on this diagram, trading stock and depreciable property. So in both regards, if we are transferring trading stock from, say, the sole trader to a corporate or trust environment, or depreciable property, we're directed to use market value for those transfers. Therefore, if market value is higher than cost in the instance of trading stock, we're going to pay tax on exit, or we're going to have a tax charge on exit. It will be an accelerated one because, of course, the trading stock will have a higher cost base within the new entity that we can adopt at a later date, but it's still a cash flow problem. And similarly, with respect to depreciable property, there are those rules which will effectively claw back the depreciation deductions that we have previously claimed with respect to that depreciable property. So those are just two obvious things to be aware of if we are transferring business assets. If we move to more of the corporate environment and we are looking to change a shareholder, i.e. an individual, to a trust, then the first two obvious places to start for us as tax advisors is, what does this have, or what impact does this have on our ability to carry forward imputation credits and or tax losses within the underlying company? So from an imputation credit perspective, imputation credits can be carried forward by a company provided we maintain 66% shareholder continuity. That's a reference to having effectively 66% of the same shareholders at the time the imputation credits arose. We want to make sure that the persons who indirectly bore the tax cost take advantage of any benefit when those imputation credits are attached to dividends. So we need to watch out for imputation credits. Do we lose them if we transfer from sole trader to trust? And prima facie, yes, we would. The workaround that we always use or look to as a rule is pay a dividend before you do the shareholding change. And Iain's going to talk about dividends later as well. For tax losses, slightly different, same scenario under current legislation, but the 66% drops to 49%. However, as Iain has alluded to, it's very much expecting to move to a more concessionary regime with respect to tax losses, such that if we breach the 49% threshold, providing we carry on a same or similar business, those tax losses should not be forfeited. That's legislation in the wings. We don't have it yet, but we are fully expecting it possibly later this month. I want to touch on GST because I think GST is something that's quite readily missed, especially where you have associated person transfers. Don't forget, while it may be an in or an out, you still need to manage the cash flows. So if there is a GST cost on the supply of the business to another entity, then while there may be an input tax on the other side, you still need to be looking at those cash flows and making sure that you're not adversely impacted. Of course, if we are selling a business, we're almost going to certainly turn to our going concern provisions, potentially our compulsory zero rating of land, depending on what's included within the supply. And that will direct us to use zero rating for GST, hence removing that cash flow problem. However, again, we've just got to make sure that we run through the hurdles and jump through those hoops to make sure that we can avail of the 0%ers. For example, if you are looking to transact a supply as a going concern, there are a number of criteria that you need to meet, including having a written agreement that the supply is to be treated as a going concern, i.e. that both parties agree we have a going concern here. That's GST. The biggie here is the avoidance angle. And this is really where Ian's graph comes into play. So whatever we do as changing structures, etc., we just want to make sure that we're not dipping into some of those bad behaviours. So in terms of bad behaviours, from the tax advice perspective, that's avoidance. And we don't like to avoid. We avoid avoiding. Our job is to mitigate tax legitimately and fairly, and make sure that you are efficient in your endeavours without walking down that avoidance tightrope. And there is a little bit of beauty in the eye of the beholder. Depends who's talking about avoidance. You've got various views on avoidance and lots of case law to work within. But avoidance is going to be one of the biggies here, or that bad behaviour. And we are more than confident that Inland Revenue is preparing and will be ready to start considering some of these angles that I'm going to go through on the next slide, please. Okay, so the first two angles of avoidance, attribution and penny and hooper, they're intertwined. One being more specific anti-avoidance, and the other a general avoidance position based on previous case law. And these two areas revolve around it's the concept of being paid for rolling your sleeves up, personal exertion, a reward for services. So what the Act doesn't really like in terms of the Act, well, it doesn't like from an attribution point of view, is that I can't just go from a sole trader to a company environment where the company earns all its income from my personal exertion and has pretty much, say, one customer. The rules are a bit more specific than that, but that's the general idea. If I interpose the company, I'm moving to and not pay myself anything, then I move to a 28% tax rate and have a deferral opportunity. The legislation is smart. They know this. The policymakers have worked it through. And effectively, if you fall foul of attribution, then for tax purposes, we're just going to ignore that interposed entity. That company does not exist for our purposes. The income is deemed earned by you, and you just follow the normal rules as if you're an individual earning the income. Company never existed. Penny and hooper revolves around the same concept. It's case law based on a couple of surgeons who interposed entities and managed to reduce their tax rate as a consequence. Taken to court, Commissioner won. Now, penny and hooper is your general avoidance. As I said, it doesn't have such specific criteria or hoops or thresholds that we need to work within, but it does revolve around the personal services of the individual and ensuring that that person receives an adequate reward for what they are doing. Now, Inland Revenue, subsequent to the decision in Penny and Hooper, issued us a revenue alert outlining their thoughts. Now, in terms of working out what would be an adequate reward for the services provided, don't just jump into thinking I'll just use a market salary or a comparable. Inland Revenue has been quite careful to explain that they aren't necessarily looking for that market salary or comparable. For example, it wouldn't necessarily be fair to pay a market salary if that would put that company in a loss position. So their default position is that they're going to look more closely at structures that interpose and shelter income if 80% or less of the income does not find its way through to the individual's hands. Now, the 80% is just a guideline. There are various arguments and concessions that Inland Revenue has conceded that there may be reasons as to why you wouldn't be at that 80%. For example, you've got many people working for you. You're highly leveraged with machinery or people. In addition, you may be going through a reinvestment program, or impacts on the business suggest that it would be a bad idea to pay the money out of the business and it should be kept within the business, perhaps a COVID-19 type event. So attribution, penny and hooper really are, or penny and hooper, just watch for that bad behaviour. Inland Revenue is going to be looking very closely at it. It's not scientific, it's just something to be aware of, just so that you don't fall foul of that grey line. Excessive payments is effectively the inverse. It's more akin to playing the bands. It's no surprise that we do have a spike in New Zealand where lots of people get paid $70,000. At the moment, $70,000 is the threshold before we hit the 33% tax rate. So we like to use up, or the human nature is to use up lower rate tax bands, and therefore we hit we look to pay people $70,000. Inland Revenue looks at this as well. There are various rules around excessive payments. Please be careful if you are going to pay a relative perhaps something more than they're worth, or if you don't have a bona fide agreement, they're not really doing anything. It's just something to watch for. For example, if there's excessive payments in respect of a corporate environment, company pays a salary to related persons who don't really do anything, then the commissioner can whip in there and deem the excessive amount to be a dividend, and that unravels the benefit. So excessive payment, something to watch for as well. Debt creation. This is the interesting one, and we've seen Inland Revenue take some far more aggressive stances on this in this area at the moment. It's a complicated area, but essentially what we are referring to here is transacting effectively between associated persons. We might create, or we will create, a capital gain, large capital gain, and a debt between those two associated persons. So if I think of it in the company environment, I have a business, sole trader sells the business to the company for asset value and goodwill, and creates a debt. So we have that goodwill is your capital gain, and we have a debt between the company and the sole trader. The company makes money going forward, which would ordinarily be transferred to the individual as a dividend. However, the debt effectively substitutes that dividend such that we can repay the debt in substitute for the dividend and pay no further tax than that 28 cents. There is specific anti-avoidance legislation which refers to layered corporate structures and dividend stripping, but we have seen Inland Revenue try and take this a bit further with respect to that example I just made, sole trader to company, which is effectively starting to look like a pure capital gains tax. Not successful at this stage, but we're highlighting it as I think it would be prudent to watch this space and see what happens. The 11% deferral is quite attractive. So yes, we do have structural, the ability to review our structures and perhaps generate some tax opportunities, but we need to do so with care, understand whether or not it generates a tax liability on the way out, i.e. trading stock, depreciable property, etc. And also make sure that we're stepping within the realms of good behaviour and not bad behaviour, as Iain has already mentioned. With that, I shall now pass back to Iain, please.
Yeah, thanks, Mark. I think that debt creation example is quite an interesting one when it's you're taking a sole trader and they're incorporatizing for various reasons, and it's sort of part of the natural business life cycle of a business where it's expanded and gone into a corporate structure. Look, it doesn't just apply to reviewing your existing structures. There's also going to be discussions going to have around future opportunities, and it's not just about the ownership of your existing business. Take, for example, at 39%, a deduction in your personal name is, more valuable now. Let's face it, you would reduce your taxable income by your tax take by 39% rather than 33%. Now, deductions, in the past, we used to have quite a lot of people investing in residential rental properties on a highly geared basis, and we're creating a tax loss. Now, that's all been quarantined, obviously. But there was benefits in having that loss offset against your personal income. But the residential rentals have been quarantined, but there may be other business investments that you're looking to invest in, whether it be commercial property, for example, or into sort of startup businesses where there's the possibility of losses being incurred in the early years. And if you've got a structure where that investment's been set up in a sort of a look-through type of entity, whether it be a look-through company or a limited partnership, there's opportunities for that loss to come back to offset against your personal services and your personal income and get a tax benefit at 39%. So the losses and the deductions become more valuable. So that would be one of the things to look at. Of course, once the company once the limited partnership or the look-through company starts to become profitable, you'd want to look to change that and change that shareholding into a trust at that stage. I'll talk to tax efficient remuneration in a separate slide, but I guess what Mark has highlighted to me is that there are conversations that we haven't been having over the last few years as the top tax rate has been aligned at 33%, which are going to come back into the conversation around paying market value salaries and making sure you're getting the right income out. I'll talk about dividend acceleration separately as well, but don't forget your passive income. We are talking about the top 2 to 3% of income earners, and what they've done is over that period they've earned income, they've built up a capital base, and it's not that they can employ expensive accountants or tax lawyers to try and avoid tax. It's just that they do things. They invest in things. They've got capital to invest in businesses, to take on startups, and to do real things. And if they're investing, don't forget that there is passive income needs to be looked at, and where does that passive income sit? All of us would say that should sit in a trust, and most people will have it in a trust. But you've also got the PI rate, the portfolio investment entity tax rate, where there is tax capped at 28%. And there is no, as far as we're aware, no proposal to change the PI tax rate, but we'll come to that in a little while. So don't think just about reviewing your existing structures, but look to have a conversation about new investments and new business opportunities and how they should be structured, and look to using limited partnerships and look-through companies as alternative investment vehicles where you think there's going to be tax losses in that initial year. Let's move to the next slide. Look, I think there's a low-hanging fruit potentially, depending on how the state of play. If you've got a company and you've got shares held in the company as an individual, if a dividend is paid after 1 April 2021, assuming that is the application date, and I've mentioned, we're uncertain about that, then that dividend will be taxed at 39%. Resident withholding tax is likely to have to be deducted at 11%, not at 5%. So there is if your company is pregnant with imputed retained earnings, and imputed retained earnings means retained earnings where you've got a stack of imputation credits which is created out of the tax you've paid on the profit that's been earned in the prior years. Now that tax will be at 28%, and so when you pay the dividend, you've got to top up the dividend by resident withholding tax up to 33% at 5%. So if your company's got a stack of retained earnings and a stack of imputation credits, there will be benefits, or there would appear to be benefits, to paying out a dividend as soon as possible. Now, I recommend an interim dividend before Christmas. Why? Well, we don't know if the application date will be 1 April 2021 or 1 January. Our guess is 1 April 2021, but until we know that for sure, there is some uncertainty. So at least be prepared to pay a dividend before Christmas. Second thing you should think about is that do not be one of those companies who doesn't take account of their financial position as they're going through the year. Sends their accounts to their accountant, who prepares the accounts and then does, oh well, you've made too much money here, let's pay a dividend out to the shareholders. That dividend is going to be put through in the journal entries after 1 April 2021. That dividend is likely to be deemed to have been paid after 1 April 2021 and should be taxed at 39%. If you're backdating the dividend to try and indicate that it was paid before 31 March 2021, then I think you've got you're going to have a real problem, and it will be a focus for the Inland Revenue. That's if it's going to individual shareholders and not to trusts, obviously. And that's where the personal facts and circumstances are so important. So pay it before 31 March, possibly prepare the documentation now and pay it before 31 December if you can. And don't forget that when you're paying a dividend, you have to look at the solvency test and do the appropriate resolutions to make sure your company can still pay its debts as they fall due after the dividend has been paid. Can we move to the next slide, please? I mentioned one of the you may have some employees, or you may be owners in your businesses, and it is worthwhile with this change in tax rate to look at whether there's any way you can review the remuneration and how you remunerate those people. The sort of areas that we've come up from that come up time and time again are will there be a benefit in providing a fringe benefit rather than pure salary to individuals? The Labour announcement was that the personal tax rate would increase and there'd be no other changes. But I think the FBT rate, when we had 39% before, was increased at top level to about 63%, I think was the percentage that equated to a 39% tax rate. So I'm expecting FBT and PAYE to be aligned. That would be consistent with tax for the last 20 years. So it may not be that there is a benefit there, but there's valuation rules around cars and other toys, if you like, which there might be some marginal benefit worthwhile having a look at. Salary sacrifice. This is where, let's say, the contribution to a superannuation fund or a KiwiSaver, that the tax that's withheld in that ESC, which is when it's paid into the super fund, if that's not aligned to the top personal tax rate as well, if it remains at 33%, then there'll be some benefits of potentially providing a salary sacrifice. Now, the Revenue were alert to this when we had the 39% tax rate before, but I don't recall them introducing specific legislation to counter it, but they did issue alerts that there would be a problem practice if somebody had taken a salary sacrifice, stuck some money in a super fund, and then applied to get it refunded shortly thereafter. But you may have some staff who are senior members of your team or owners of the business who, if those tax rates aren't aligned, might be in a position where they can look to put money away to the pension, to a pension, and get a benefit there. You may also have senior people where you could give them an equity stake in your company, and that equity stake would give you give them the opportunity to participate in dividends from the company. The equity stake would suggest be put into their into a trust if the trustee tax rate is still at 33%. There'll be income splitting opportunities. Mark's commented on them before, but don't forget that might come through a structural change where you could make a look-through company and you can have your spouse with a 50% shareholding in the profitable company, or more than 50% in the profitable company, and take out the percentage of the profit into their own name. That's a much easier income split than declaring a salary for a person who may not actually do much work in the business. But I think there's a low-hanging fruit one, and that's the very first point there, and that is to pay senior people, bonuses to your senior people who are going to be affected by this tax rate. Pay them early and before the application date. Personal services employment income is taxable when it's paid, deemed to be derived when it's paid. Now, in the past, you would claim a deduction, you put an accrual in your year-end accounts, and as long as you paid it out within 63 days, the deduction was allowed in your current income year. So if you got a 31 March balance date, as long as you paid it out by 2nd or 3rd of June, whichever the 63 days was, you got your deduction in the 2021 income year. If you do that this year, then that bonus will be taxable at 39% in June when it's paid to those employees. So considering paying a large portion of the bonus out before 31 March, again, assuming it's a 1 April deadline. Next slide. We're close to finishing and we'll get onto the questions very quickly. So look, watch this space. There are certain things that we don't know. There isn't a lot of detail yet. The implementation date is still uncertain. I personally think it will be 1 April. It makes sense to me. Will the trustee tax rate be aligned to 39%? I don't see that. I think the trustee tax rate will stay at 33%. There are too many trusts that would be have passive income where for potentially senior retired citizens who'd be badly affected by that by an increase in the trustee tax rate. And the trustee income tax rate of 33% is not proportional. It doesn't increase according to the amount of income derived by the trust. I think you can expect that the resident withholding tax, the FPT rate, will be aligned, but I don't believe that I don't know if the contribution tax to superannuation or PI tax rates will be aligned. The PI tax rates, I think, will stay at 28%. So there'll be opportunities there, so watch that space. Next slide. Finally, before we get on to the questions, what should you be thinking about today? Well, I think just to recap, we think there are some low-hanging fruits where you should review not only your existing structures to determine if they're fit for purpose, but look at new opportunities and where they should fit within that structure. Don't assume it should go straight into the trust, because if there's losses, it might be appropriate to set up a look-through company or a limited partnership, etc. Be prepared to pay dividends and bonuses, possibly before 31 December or before 31 March. But I would put the preparation in to be prepared to pay it early in December, just in case we get a surprise. You can look at the remuneration strategies for senior staff. I suspect that will be a limited area of opportunity because I expect the FPT and rates to be aligned. But I think in salary sacrifice, I could imagine, and maybe it's reflecting my age as I get closer to retirement, there will be opportunities for some people to salary sacrifice and stick some money into a super fund and at a lower tax rate. But I think you've got to take care in planning for those changes. You've got to be mindful of the likely tax benefit that you're going to get. And we've got to heed the lessons from the past. And the last point I'll just say on that, heeding the lessons from the past, it is not unusual when the tax rate goes up to 39% that sort of tax schemes appear in the market. Whether it's structured finance, God knows, film deals might come back into it, that people will see that there is smart schemes that can be structured in order to give a deduction to people. And if they're thinking it's 39%, maybe it's worthwhile making that investment. I would be very, very cautious about accepting or investing in those types of schemes. We've never been a firm that's marketed those types of schemes, and we've seen the pain it's caused when the inland revenue come in and start to fight them. So be careful out there. It's almost like cybersecurity. Don't open the link and don't make the investment. Okay, so that's all I wanted to say. So we'll just get on to some questions that hopefully we've got from the tax chat.
I've got some here, Ian. Just before we go on to it, I think I share your views regarding pies and super, on the basis it's a good opportunity to incentivise saving for the future. Therefore, leave that little bit on the table, so that we don't find ourselves in problems later on. So questions. Sorry guys, I'm looking to the right because my questions are on my right.
I'm looking to the left, and that's a bit silly because my eye patch is on the left. I can't see it.
So first question. So we've got a typical structure. You've got a company owned 98% by a trust, 1% to individuals. So that would be normal. People like to use that shareholder salary type thing and work their way past PAYE, hence the 1% to the individuals. We've got one individual who is the sole director and takes in excess of $180,000 per annum from the company. And what they want to do is to drop the salary less than 180,000 and pay all the rest, all the difference through as a dividend to the trust. And the question is that avoidance? I think it'll be particular to the facts of the case, but a blatant drop of salary as a starter without good reason doesn't feel quite within the realms of good behaviour. And certainly if you then pass all that income back through to that individual, but via a trust, you haven't really used any of those good examples, i.e. The business require more income to be retained. We've got a reinvestment. We've had business problems with COVID-19, etc. So my immediate reaction is, if I were Inland Revenue, I'd look at that one. Ian, have you got any views on that?
I think it's a great question, isn't it? You know,
yeah.
And it's obviously one of those. It's one of those ones that's hard to understand. Look, if you were on 200,000, you dropped it to 180. What's the point? You know, just you're not saving that much money to take on that risk. But if you're on 500,000, you drop it to 180. I think you're into the penny and hooper type scenario, because you know I think the lessons from the past were that, and I'm not picking on the chiropractors because I think they had legitimate business structures that had been changed, etc. But they had been earning income in their own name in excess of 600, 700,000. And suddenly they were paying themselves a salary of 140 or something like that. And that was just too much to stick in the throat of the Inland Revenue. So I think it's a question of balance. I think I've never been one to fancy the 70,000. I think if you give them something, you should be able to do it. But I think you need to look at that business. And I think, Mark, you're quite right. If it's about dividends and retaining profits for an investment in the company, in order to shore up the balance sheet with the impact of COVID, then that's perfectly legitimate to do, and that should be documented and clearly documented. But then you know, when do you pay those dividends? If you are still drawing the money out from the company and you're creating an overdrawn shareholder loan account, because you're still using that to live on to fund your lifestyle and pay for all your personal costs, then you're going to have to clear that overdrawn current account at the end of the year via, and if it's in your own name because you've drawn it out for your personal name, and that was part of the Penny and Hooper problem, that from recollection, was that the money went up to the trust and then went straight out to the individuals to pay for their personal stuff. So
I'll go to the next. Shall I go to the next question, Ian?
Sure.
Thanks.
Yeah, I haven't read the next question, so that would be
No,
good.
that's all right. I have. I was listening to you as well, but I was looking to the right too. So one of the questions is, I like this one too, just purely a view, obviously, but what do we think about reverting back to 33% once because this 39% was a COVID-19 policy for Labour. Once we've got through this and we don't need the stimulus or whatever it is they're looking for, do we think it will go back to the 33? My immediate reaction is, I guess it depends who's in power at the time. We know policy really don't like the differential, so there'll be a lot of lobbying. Certainly, company to individual, we were at 11%. That's quite a big leap from the 6% that Ian was talking about earlier. So there's going to be a lot of lobbying in that regard, I would have thought. And yeah, like I said, it depends on who's in power. Ian, have you got any thoughts?
I wouldn't rely on that tax rate reducing to 33% in the future with Labour being in government. I think once it's in, it's in.
Yeah,
and I think there's an expectation that there's going to be stickability with it. That people say somebody's on 220, 250, they're just going to pay the tax and keep life simple. And as you know, when the pain that sort of a hard IRD investigation comes in is a problem. So we got some other questions. If we normally declare and pay dividends in May, but bring forward our dividend payment due to March, is there any risk that could be considered avoidance, or is it just good planning? I don't think that that is avoidance in any stretch of the imagination. I think it is absolutely good planning. It is I would declare it as an interim dividend because you may not know your results, and in fact the revenue might think this is a good idea because you're going to collect a chunk of resident withholding tax at 5%, which they wouldn't otherwise get. You know, what we found the last time was that companies just didn't pay the dividend. The 5% itself is almost a cash flow cost that they don't like paying, and so you end up building up a bucket of retained earnings with imputation credits. You run the risk of a change in continuity if you have a new investor coming in, and yeah, they just sort of defer that. So I think the revenue might turn around and say that's a good idea, pay the dividend early, we put more tax into the coffers of inland revenue, and thank you very much.
But yeah, I agree with that, Ian. I think that this could be a clever plan because people do hole up their dividends and don't want to pay the 5% top up, whereas this could be seen as a clear incentive to accelerate your dividends and get money into Treasury quicker, as opposed to say 1 April and sitting on it again. So there might be a windfall gain here for the Treasury by allowing people the opportunity to pay earlier than otherwise they would have done, and that might be all part of the wider game plan. So I agree with you there. There's another one here, Ian. I don't know if you've had a chance to see it, but the question is, do you think there'll be any chance that eventually tax will be calculated after KiwiSaver contributions rather than on gross earnings, so tax relief at source into pensions, to encourage people to put more money away for retirement, get a tax reduction in the process? Look, from memory, I think there was some relief when KiwiSaver first came out. I think it was possibly short-lived, but I think there was some small amount that might have offered relief at source. This would have been something as well that the tax working group would have considered, and on 2 occasions, and probably discounted on 2 occasions. I think this is a question that's going to crop up time and time again. Personally, I think it's a great idea. I come from a background where that happened, and it did really encourage people to save. So look, whether or not it comes in, I don't know, but will it be asked again? Yes.
Yeah, it's a really good question, isn't it? It goes back to the Todd review of superannuation back in 1990, and Mark, you're too young to remember that, but I was here in the country when that was going on, and they removed the incentive to invest in superannuation funds for a whole variety of reasons. better to pay off your interest on your mortgage than and that sort of stuff. But I think if you look at the success of KiwiSaver, where people have really embraced it and stuck money away into KiwiSaver, it has shown that actually it has encouraged a savings culture. This would be a change where you're going from a, rather than a tax exempt system. If you're going to get relief up front, you're probably going to go to something like an exempt tax system, which is a more complicated question. There was a further question. I think this will be the last one. Could we just get 2 or 3 minutes to wrap up? Salary sacrifice, would this mean an update change in an individual's employment contract first? That's also a very good question, and there's probably a couple of things that we deal with here. Yes, absolutely. If you're touching anything to do with an employment contract, you need to go through that employment rules. The employees have got rights, and you need to take advice on that. That also brings me back to looking at the trustee position. Is something we didn't mention, but obviously we've got the new Trustee Act coming out, coming into force next year, where beneficiaries of trusts have got to have the right to be informed that they are a beneficiary of a trust, and there's a whole lot of new obligations on trust. Now, we are aware that there are people who have just gone around and said, look, I set up a trust years ago, just owns a family home. I don't really purpose of that. I'm just going to get rid of it. This change in tax rate that might have been premature to make that call to get rid of the trust. So please review your trust structures. I think they're still a great vehicle for protecting your assets and passing on intergenerational wealth to your family as you build up that basis. And despite the new Trustee Act, you've just got to comply. That while it puts more onus on you, I think it's not to be shied away from. The trusts do have a purpose.
Okie doke. So, interest of time, thank you, Iain. I'll wrap up here. Look, thank you all for attending and participating. Thank you for your questions. It's excellent, much appreciated. In terms of the seminar itself, the webinar, please think about your structures. Don't dip into those bad behaviours. Get ready for a dividend, and think carefully about remuneration and perhaps your employees and bonuses, etc. Talk to someone in the BDO team if you need assistance. I'd be remiss if I didn't thank our really cool team behind the scenes, who you don't hear and you don't see, but Jamie, Caitlin and Charlene, thank you so much for keeping Iain and I on point, looking after our slides and making sure people can hear and see us. So very much appreciated. For everyone else listening, this is the last rethink of the year. More to come next year, but like to again thank you all for joining us. Have a very happy and safe Christmas, and with that, I believe Iain is off to watch James Bond, and I'm going to have a game of darts. So thank you all, and see you soon.
Thank you.
Cheers.
All right.